There's a pattern in economic history that repeats with mechanical precision. Not every decade, not randomly, but when specific conditions align. Extreme asset valuations, record debt levels, excessive leverage, widespread belief that this time is different, and a trigger event that forces liquidation. These conditions existed in 1929, they existed in 2008, and right now in 2025, every single one of these conditions exists again. Not similar conditions, identical conditions. The stage is set, the players are positioned, and if history is any guide, the crash will come in late 2026 or early 2027. This isn't prophecy, this isn't doom-mongering, this is pattern recognition. Let me show you exactly how crashes unfold, who loses everything, who profits enormously, and why the 2026 crash could be worse than 1929 and 2008 combined. Because the scale is larger, the leverage is higher, the interconnection is deeper, and the people in power have used all their ammunition fighting the last crisis, leaving nothing in reserve for the next one. What I'm about to show you is a documentary analysis of a crash that hasn't happened yet, but follows a pattern that has happened twice before with devastating accuracy. The mechanisms are the same, the timeline is predictable, and the outcomes, who gets destroyed and who gets rich, follow the same script every single time. Let me start with where we are right now. January 2025, the setup. Every crash begins with a bubble, and we are currently in the largest everything bubble in history. But it's not just stocks. Real estate in major cities is at all-time highs. The median home price in America is $420,000. The median household income is $75,000. That's a ratio of 5.6 to 1. Historically, sustainable ratios are 3 to 1. At 5.6, housing is 87% overvalued relative to incomes. In 2006, before the housing crash, the ratio peaked at 5.0. We're higher now. Corporate debt is at record levels. Non-financial corporate debt in the United States is $13.5 trillion, 72% of GDP. In 2007, it was 43% of GDP. Corporations are more leveraged now than before the last crisis. Government debt is $36 trillion, 120% of GDP. Interest payments alone are approaching $1 trillion annually. And consumer debt, credit cards, auto loans, student loans, totals over $17 trillion. Total debt in the U.S. economy, government, corporate, household, financial sector exceeds $90 trillion. That's over 320% of GDP. Every sector is leveraged beyond historical norms simultaneously. This is the everything bubble. Everything's expensive, everyone is in debt, and everyone believes prices will keep rising forever. Why do they believe this? Because for 15 years, since 2009, the Federal Reserve has guaranteed it. Every time markets started falling, the Fed cut interest rates or printed money. Quantitative easing. QE1, QE2, QE3, COVID stimulus. The Fed printed over $8 trillion from 2008 to 2022. This money flowed into assets, driving prices higher. Investors learned a simple rule: buy the dip, the Fed will save you. This conditioning created moral hazard. No one fears risk because risk has been eliminated by central bank intervention. But there's a problem. The Fed has used its ammunition. Interest rates were at zero for a decade. They can't go lower. The balance sheet expanded from $800 billion in 2008 to $9 trillion in 2022. There's limited room for more expansion without triggering inflation, which already happened in 2021, 2022. The Fed fought inflation by raising rates from 0% to 5.5% in 18 months, the fastest rate increase in 40 years. This stopped inflation, but it created new problems. Higher rates make existing debt more expensive. Corporate debt issued at 3% must be refinanced at 7%. Mortgages at 3% are now 7%. This debt burden is crushing. And the Fed cannot lower rates significantly without reigniting inflation. They're trapped. Rates too low, inflation returns. Rates too high, debt becomes unpayable. There's no good option. This is the setup. Maximum valuations, maximum leverage, and a Federal Reserve that has already used its tools and has nothing left for the next crisis. Now let me show you how this compares to 1929 and 2008, because the patterns are identical. In 1929, the stock market had risen 400% from 1924 to 1929. 5-year boom. Margin debt, borrowing to buy stocks, reached 10% of GDP. Everyone was leveraged. Everyone believed stocks only go up. The phrase permanently high plateau was used by economists in 1929 to describe the new era where crashes were impossible. Then October came. The market fell 89% over 3 years. In 2008, the housing market had doubled from 2000 to 2006. Mortgage debt reached 100% of GDP. Everyone was leveraged buying houses with subprime loans. Everyone believed housing prices never fall nationally. Then the subprime mortgages started defaulting. The financial system collapsed. The S&P fell 57%. In both cases, the setup was the same. Asset bubble, excessive leverage, widespread belief in permanence, then a trigger, and then cascading liquidation. The 2026 crash will follow the same pattern. We have the bubble, we have the leverage, we have the belief that Fed intervention makes crashes impossible. All we need is the trigger. And there are multiple candidates. Let me show you the three most likely triggers and how each one could start the cascade. Trigger 1, commercial real estate collapse. This is the most likely trigger because it's already underway. Office buildings across America are 40 to 50% vacant due to remote work. Companies that used to lease 5 floors now lease 2. This is permanent. Remote work isn't going back to 2019 levels. These buildings were financed with mortgages at 3% interest rates. Those mortgages are maturing now and must be refinanced at 7 to 8%. A building that generated just enough rental income to cover debt service at 3% is bankrupt at 7%. The math doesn't work. Building owners are walking away. Brookfield Asset Management, one of the largest real estate owners globally, defaulted on 2 Los Angeles office towers in 2023, just stopped paying. Gave the buildings to the lender. This wasn't because Brookfield is in trouble. It's because those specific buildings are worth less than the mortgages. It's economically rational to default. Over $2 trillion in commercial mortgages mature between 2025 and 2027. If 30% default, that's $600 billion in losses. Phase 3 is the cascade. This is when the real crash happens. Forced liquidation, margin calls, panic selling. In 1929, the cascade lasted from November 1929 to July 1932. The market fell 89%. In 2008, the cascade was faster, September 2008 to March 2009, a 57% fall in 6 months. The 2026 cascade could be somewhere between probably 12 to 18 months, a 50 to 70% decline from peak to trough. Here's how the cascade works mechanically. Stage 1 of the cascade, leveraged investors get margin calls. Investors who borrowed to buy stocks are forced to sell when stocks fall. They borrowed at, let's say, 50% margin. If stocks fall 20%, their equity is nearly wiped out. The broker issues a margin call. Sell now or we'll sell for you. These forced sales drive prices lower. Stage 2, institutional investors face redemptions. Mutual funds, hedge funds, pension funds, when their assets fall, investors demand their money back. The funds must sell stocks to raise cash. More selling pressure. Stage 3, algorithmic trading amplifies the decline. High-frequency trading algorithms see prices falling and accelerate the selling. Stop-loss orders trigger. Circuit breakers halt trading, which creates more panic when trading resumes. Stage 4, liquidity disappears. When everyone is selling and no one is buying, there are no bids. Stocks gap down 10, 20, 30% because there's no buyer at any reasonable price. The market isn't declining, it's collapsing. Stage 5, credit markets freeze. When stock prices are falling and panic is widespread, banks stop lending. Why lend money when borrowers might go bankrupt tomorrow? Credit freezes. Companies that need to refinance debt cannot. They default. Banks that lent to those companies take losses. The cycle accelerates. During the cascade, the economy enters recession. Stock market crashes destroy wealth. About $30 trillion in market value could be lost. Consumers feel poor. They cut spending. Companies lose revenue. They lay off workers. Unemployment rises from 4% to 9 or 10%. Laid off workers cut spending further. More companies lose revenue, more layoffs. This is the feedback loop that turns a market crash into an economic depression. Phase 4 is maximum panic. This is the bottom. When fear is so extreme that people sell everything regardless of price. In 1929, the panic bottom was July 1932. The Dow at 41, down 89%. Unemployment at 25%. Banks failing by the hundreds. In 2008, the panic bottom was March 2009. The S&P at 66, down 57%. Unemployment at 10%. Major banks insolvent and bailed out by the government. In 2026, the panic bottom could come in late 2027 or early 2028. The S&P, currently at 6,000, could fall to 2,500 or lower. Unemployment at 10%. Multiple bank failures. Government intervention. This is the moment of maximum fear and maximum opportunity. Phase 5 is the slow recovery. This begins when the government intervenes massively. In 1933, Roosevelt launched the New Deal, created jobs, reformed banking, and restored confidence. The recovery from 1929 took a decade. Stocks didn't reach 1929 levels again until 1954, 25 years later. In 2008, the government bailed out banks. The Fed printed $3 trillion. Congress passed stimulus. The recovery was faster. Stocks reached new highs by 2013, 4 years later. The full economic recovery took until 2015. In 2026, 2027, the government will intervene again, but the scale will be larger. The Fed will cut rates to zero. Congress will pass multi-trillion-dollar stimulus. Banks will be bailed out. But the recovery could be slower than 2008 because the debt levels are higher. Government debt at 120% of GDP. Adding trillions in stimulus pushes it to 150% or 180%. At those levels, debt service consumes tax revenue. The government faces difficult choices: austerity, raising taxes, or inflating away the debt. None are easy. The recovery could take 5 to 10 years. Stocks might not reach 2025 levels again until 2032 or later. This is the 5-phase pattern. Initial shock, false recovery, cascade, panic bottom, slow recovery. Now let me show you who gets destroyed and who gets rich. Because every crash creates massive wealth transfer from those who don't see it coming to those who do. Who gets destroyed? The middle class, holding stocks and homes. In 1929, the middle class that had invested in stocks lost everything. Families that had felt wealthy in 1928 were destitute by 1933. Their stock portfolios fell 89%. Their homes were foreclosed when they couldn't make payments. In 2008, middle-class homeowners who bought at the peak lost 40 to 50% of home equity. Many went underwater, owing more on mortgages than homes were worth. Some walked away, others were foreclosed.